Inside Options is brought to you by the Johannesburg Stock Exchange. Manage your risks with SAFEX style options.
Hello, this is the last episode of Inside Options, and joining me to talk us through it is James Boardman from the JSE's Equity Derivatives Division. Hello, James.
Hi, Jane.
We're excited about the last episode. We're recapping what are the most important points. Where do we start?
Well, we're going to go back into ancient history, our first episode, and also ancient history in sort of ancient Greece and Phoenicia. So we can go to that slide I've got there. You can see a trading vessel. That's a Greek trireme. Now, point of this is futures and options are far, far older than we give them credit for. They've been around for thousands of years, and Greek and Phoenician traders used to actually use them to lock in a price for the next time their ship would come around. It'd take them quite a while to get around the Mediterranean. They'd lock in a price, and they'd use something very similar to a futures contract to do that. So it's just to show you futures far, far older. In fact, probably older than stock markets. So that's quite an interesting fact that people don't know.
Right.
The other thing we saw is Thales of Miletus. He showed us that philosophers can make money in the options market. Now, what he did was he rented this sort of big thing with a ring, a mill. That was actually an olive press that you could turn olives into olive oil. Now, what he did was he went around to all the guys who owned the olive presses and bought an option on them in the expectation the harvest would be early and it would be very good. He was right on both counts. He made an absolute fortune and proved that he could make money despite being seen as sort of an airheaded, scatterbrained professor scientist of the times. People said, you're constantly acknowledged as the brightest person on the entire island, yet you're very poor. He said, I could make money if I wanted to. And they said, yeah, right, you don't have a clue. He managed to make a significant fortune using something very like an options contract that he negotiated. It's one of the first stories we have anywhere in the world of someone using an options contract. So what it takes is some foresight, some creative thinking and some planning, and he managed to implement all of those and become quite wealthy as a result of that. The other thing we talked about was Holland and the tulip mania, and how the government converted the tulip contracts from futures contracts where people had to take delivery into an options contract where they could just pay a penalty. Reason they did that was there were very few florists who stood to profit handsomely, and there were a lot of people on the other side of that trade who would possibly bring down the whole Dutch economy. So the government stepped in and managed to mitigate some of the risk using an options structure. And also with that, we've got this fantastic quote, markets can remain irrational longer than you or I can remain solvent, by John Maynard Keynes. So some examples of that are the tulip mania, when one little bulb was going for several years of a craftsman's wage, the South Sea bubble, where these papers in this company that didn't even really exist or have any assets or prospects actually, went up to huge prices, took over the whole of the London economy. One of the guys hooked in that was Isaac Newton. And he said, I can compute the bodies, the motions of celestial bodies, but the madness of crowds I don't know about. So, and the other one, I mean, more recently is the dot-com bubble, where all sorts of businesses with no prospects were floated for millions and millions of dollars, and people bought them sort of on the hope that the whole world would change.
I'd like to talk about gold on that.
Like gold. We also, we had a show on gold, and gold's just tanked recently. So that's been quite interesting. I mean, it rocketed up to $1,900. It's now back to $1,740, with news in the States that they've hiked margins further at COMEX as a result of all the market volatility in the gold price. It's probably going to fall further today as some people who are overextended exit their positions and sort of lick their wounds and hope to come back to live to fight another day.
But basically, James, this is talking about when regulation was first introduced to mitigate some of the risks.
Exactly.
Right.
Then we also talked about the derivatives risk management structure.
Yes.
Derivatives I'm sort of mainly focused on are exchange-traded derivatives that trade in the South African market on the JSE. And to secure that derivatives market, you need capital and you need payment structures, because as we noted, derivatives are a zero-sum game. Someone's receiving cash on a daily basis and someone is paying in cash on a daily basis. Now, with a system like that, there's a risk that someone won't be able to make one of the payments required of them. So we've got the Johannesburg Stock Exchange, and that is sort of at the top of the pyramid. Then there's SAFCOM. That's a virtual entity. It's South Africa's clearinghouse, made up of the biggest, most sound financial institutions in South Africa. They then individually are clearing members. They then have member firms. Those are our stockbrokers. You've got to remember that you can't trade on the JSE in any of our markets without going through one of our member firms. That would be sort of a big brokerage firm you go through. And then there's the client level, which is sort of you or I investing in derivatives. So we'd put down some initial margin. If we failed to pay, our stockbroking member would have to pay that for us. And then if they couldn't pay, the clearing member would have to step in and pay. And through this sort of channel of risk and the hierarchy of risk, that is how the system is guaranteed. And you're guaranteed to receive any profits that are due to you through that system.
Okay.
So that mitigates risk. We also looked at initial margin. Now, initial margin is your good faith deposit, kind of like a deposit on a flat. So you don't trash the place, slightly more than a month's rent in case you don't pay. They're covered for that. Same sort of thing we do at the exchange. And the interesting point with this slide is that there are margin offsets. So we can see we've got an AGL call, and short, quite a while ago, we can see the futures price there was 325. Last time I checked, it was around about 280, 300 again. So now we've got the call on its own, you'd pay 16,380. And a future on its own, you'd pay 19,000. But because these two positions offset each other, you only pay 2,260. So that's quite a massive offset from sort of the 35,000 you'd be on the hook for otherwise. And that's important to know. The other thing we talked about is in a meltdown, SAFEX style options, that's the options we trade, they're futures style options, and they're margined each day for both the buyer and the seller. In a crisis, they are safer. In the South African market, we had Lehman Brothers was one of the biggest writers of options in our market, and all their positions were transferred seamlessly. No one lost a penny that was owed to them because of this margining system. The worst thing for a clearinghouse is to receive unfunded obligations. With these SAFEX style options, premium keeps trickling across each day, and no one received unfunded obligations, unwritten options that didn't have a backing to them. With this, the cash keeps flowing. So that sort of helps to make the system safer. The other thing we talked about is derivatives are tools. I mean, there's that famous quote from Warren Buffett that we sort of bandy about quite a lot, that derivatives are financial weapons of mass destruction. We disagree with that at the exchange. We think they're more like a kitchen knife or a car. It's a very useful part of daily life, but it needs to be used with skill, competence, and alertness. And if you approach it, we hope you can, skillfully and successfully, hopefully you can be a skilled chef, not a knife-wielding maniac.
All right. Just going back to the previous slide, we talk about in a meltdown, the options are a safer route. I mean, this goes back to the debate about single stock futures and whether they are actually safer or not. So tell us again, why are they safer?
Options, you've got that limited risk. You only have to pay down that premium. That's the most you can lose if you've bought options. If you're wrong and your position moves completely against you, the most you can lose is a known amount. That's that premium. In a crisis, when things are getting frothy, it can be a good idea to use options to limit your risk.
Okay. But you still need to be skilled.
You
like
still need
chef,
to be
you
skilled.
Still need to know what you're
the
doing.
same sort of thing in single stock futures. The key is to not overgear yourself. The exchange will offer you something like about 10, somewhere between sort of usually 8 and 10 times leverage. Now, if you only have 1,000 Rand in the world and you put all 1,000 into one futures contract, one move down and you're wiped out.
Yes.
So you can manage your margin and you can have enough cash resources on hand that you're not overly leveraged. So that helps to make derivatives a bit safer. You don't want to be geared excessively, and the slightest reversal can sort of carry you out. So that's part of being a skilled chef.
Okay, James, in the second segment, we're going to be talking about synthetic longs and long calls, I think.
Yes,
so we're starting to get a little bit technical again, so we'll look at summing that up. Don't go away, we'll be right back.